Many traders sit in front of the charts all day, but the truth is, you only need to focus on one small window of time. That window is called the kill zone. In this video, I'm going to break down exactly what the ICT London kill zone is, why it's so important for traders, and how you can use it to find high-probability setups in the market. By the end of this video, you'll understand when the London kill zone happens, the psychology behind it, and the London kill zone trading strategy step by step, which is one of the highest quality trading setups ever created. What are the kill zones? Kill zones are basically the important times of the day when a lot of liquidity enters the market, providing perfect trading opportunities. In this video, we're exclusively focusing on the London kill zone. The London kill zone refers to a specific time window during the London session when the market tends to experience major moves. But first, how to identify London kill zone on the chart? Open the chart on TradingView and simply select the Indicators tab. Here, write Market Sessions and click on the indicator provided by Leviathan. This indicator shows all of the sessions, so we need to make some adjustments. So, in the Settings tab, first uncheck the Tokyo, New York, and then change the close of the London session to 1300. Then, we are going to have our London kill zone marked on the chart. We also need to enable our period separator on the TradingView platform. So right-click on the chart and click on the Settings. From the Events tab, select the Session Breaks. Then the vertical lines dividing each day will pump up on the chart. But why is this kill zone pretty important? During this time, several important things happen in the market. First, the London financial markets open, bringing a large amount of momentum into the market. Second, traders begin positioning themselves for the day, which often leads to establishing the daily directional move. And third, liquidity is being taken from previous highs or lows. Because of these factors, the London kill zone often produces strong price movements and clear trading setups. Why the London kill zone works? To understand why the London kill zone works, we need to think about liquidity. Markets move because of orders, and large institutions need liquidity to enter their positions. One of the easiest places to find liquidity is above previous highs and below previous lows, where many retail traders place their stop losses. During the London kill zone, the market frequently moves toward these areas to capture liquidity before making the real move. This is why traders often see false breakouts or quick sweeps of highs and lows during this time. Once liquidity is taken, the market may reverse and begin a strong move in the opposite direction. Understanding this behavior can help us identify potential entry opportunities. Now we move on to the next topic, the London kill zone trading strategy. This trading strategy combines multiple concepts: buy-side and sell-side liquidity, liquidity grab, fair value gap, and inversion fair value gap. So let's quickly review these concepts. Buy-side and sell-side liquidity. Liquidity above a swing high is called buy-side liquidity, and liquidity below a swing low is called sell-side liquidity. The market often moves toward areas with resting liquidity because that's where many orders are waiting to be filled. In this example, these are our identifiable swing highs and lows, which we mark as liquidity levels on the chart. The reason is that these points form levels of market structure where traders have previously entered the market. If price pulls back to these levels, there is a higher chance that traders will place orders again. So liquidity tends to build around these levels, and this is where manipulation can happen. Liquidity grab. A bullish liquidity grab pattern happens when price wicks below a liquidity level or even closes below it, but then quickly returns inside the range. Now, what does this show in terms of price action? It means that the market was reaching for liquidity below the support by triggering stop losses and trapping breakout traders. This is often a strong signal that the market is likely to move in the opposite direction of the liquidity grab. For example, if price sweeps above Asian high during the London opening, but then quickly closes back below the level, it shows buyers have been trapped. This gives traders a chance to look for short setups, expecting price to reverse and move lower. The same logic works for a bearish liquidity grab pattern. A bearish liquidity grab pattern occurs when the price moves above a key liquidity level, triggers stop losses and buy orders, but then quickly reverses and closes back below that level. This shows that buyers have been trapped and selling pressure has taken control, often leading to a move lower. For example, in a clear downtrend, if the market gathers enough liquidity, the next downward movement is likely to occur, creating a short trading opportunity. When a liquidity grab pattern forms at a resistance level, it can be a strong signal that the market is likely to move downward. Fair value gap. A bullish fair value gap is a space between the upper wick of the first candle and the lower wick of the third candle in a three-candle sequence. It shows a buy-side imbalance, where buying pressure strongly outweighs selling pressure, causing this gap in price movement. Traders often see this gap as an area of interest and use it as a demand zone to go long. The same concept applies to the bearish gap. Inversion fair value gap. An inversion or inversed fair value gap is a failed gap that gets disrespected by the market. For example, here we have a bullish imbalance that caused this gap. When price pulls back to this area, we expect a rejection to the upside. However, the next candles close below the gap, completely disrespecting it, which creates an inversion. Now, what's the psychology behind the inversion fair value gap? The formation of an inversion fair value gap is one of the early signs of shifting momentum in the market. It shows that the side that created the imbalance lost control. This sudden shift in momentum signals a possible reversal. From basic price action, we know that after a breakout, support turns into resistance and vice versa. Same thing applies to fair value gaps as well. When a bullish fair value gap that used to be our demand area breaks to the downside, it turns into a supply zone. So now we can anticipate a rejection from the inversion gap to the downside. Now let's continue with the London Killzone trading setup. You can use either the 5-minute or the 15-minute chart to execute this strategy. The first step is to identify the buy-side and sell-side liquidity levels formed during the Asian session. These levels often act as targets for the market once London opens. Next, when the London Killzone begins, wait for the price to reach one of these liquidity levels and form a liquidity grab pattern. This usually happens when price briefly moves above the level, taking out stops before reversing. After the liquidity grab, wait for the market to create a fair value gap. This imbalance will act as our point of interest. To execute the trade, place a sell limit at the beginning of the gap, set your stop loss above it, and target the next liquidity level below the price. The second entry model appears when an inversion fair value gap forms. This is an even stronger setup because it represents a sudden shift in market momentum on top of the other signals. Just like with the regular fair value gap setup, you can place a sell limit at the start of the inversion gap, put your stop loss above the zone, and aim for the next important level in front of the price. The third scenario occurs when a regular fair value gap overlaps with an inversion. When these two zones align, they create a high probability confluence area, providing a very strong setup to enter a short position. Finally, as the trade develops, manage your risk properly. You can take partial profits and allow the rest of the position to run toward a larger target. Now, let's look at some of the real chart examples. Here on the Euro-Dollar 5-minute chart, let's mark the key liquidity levels in the Asian session. Here we can mark the buy-side and sell-side liquidity like this. Now, with the opening of the London Killzone, we want to see a liquidity grab pattern formation around either of these levels. So let's play the price forward. Now we can see that the price has engaged the liquidity below the equal lows and quickly returned back inside the range. This is the first signal that the London move will be a push to the upside. Next, we wait for a bullish fair value gap to form and simply set a buy limit at the start of the zone. For taking profits, you can target a fixed amount like 1 to 2 or 1 to 3 targets, or aim for the next important liquidity level in front of the price. We can also add higher timeframes analysis to our trading strategy. Here on the pound-dollar 1-hour chart, we have a moving downtrend. The market continuously breaks the structure levels to the downside, which shows the selling pressure. Now we will identify this market as bearish and look for short trading opportunities as long as we stay below this swing high. Now let's zoom into the 5-minute chart. First, remember that the higher time frame direction is bearish, so we are only interested in selling this pair. Now we will mark the important liquidity zones, which is buy-side liquidity created in the Asian session. We know for a fact that many traders have bought this pair in this resistance area. So, an optimal scenario for the big players would be to push the price above the equal highs and grab the liquidity they need and continue pushing downwards aligned with the dominant downtrend. Now let's play the price forward and see what happens. The market pushed the price higher and engaged the liquidity above the equal highs and quickly returned inside the range. Now, how do we enter the trade? This overlapping area of fair value gap and inversion would make a perfect trading zone to look for a short entry. Risk management. Even though the London Killzone can produce strong setups, proper risk management is still essential. No strategy works 100% of the time. That's why you should always use appropriate stop losses, manage your position size, and avoid overtrading. The goal is not to win every trade, but to consistently take high-probability setups with controlled risk. The ICT London Killzone is one of the most important time windows for traders who focus on intraday market movements. By understanding how liquidity works and how institutions operate during the London session, traders can better identify potential opportunities. Instead of watching the charts all day, you can simply focus on this specific time window and wait for clear setups to form. Thanks for watching, and I'll see you in the next video.